Now, as we pivot to the consumer, we really have to look at what is happening at the most basic level, which is what is happening with savings, what is happening with the credit cards, and how is that going to impact their ability or their available capital to spend. So when you look at some of I thought this was an interesting thing of which of the following statements best describes the influence that inflation has had on your savings habits. Due to the rising prices, I now have less money than I used to because I can't afford it anymore, is 41%. And I think that's really interesting when you start looking at the different impacts that have happened. Due to rising prices, I now save more money is 10%, but due to rising prices, I now save more money than I used to, but for another reason is 4.6%. But the most people are saying I now save less money than I used to. So the question is going to be how quickly does that essentially whittle down, and it's always going to vary based on the person, the amount of income. So when you take that and then you look at commercial and industrial loans at all commercial banks, so that's the consumer side. Then you look at the CRE side, well, the base effect from the COVID shock, and when you look at it, we're seeing that bigger slowdown. So the banks are going to struggle to give additional credit and leverage to the consumer, and they're really going to be difficult and hard-pressed to give more to commercial banks, and that's where we continue to see some of these underlying problems. So then when we dig in a bit further into what is happening at the consumer level, median household savings and checking balances by income indexed to 2019, you get an idea that there's still some of that elevated amount that's there. But then when you look at that data from the Bank of America, show that savings and checking balances for spanning 50 to below 250 are higher than they were in 2019. But then when you look at it a little differently, and this looks at the aggregate personal savings versus the pre-pandemic trend, you can see that things are a bit tighter. Now, remember last week we showed that there was an assumption that there was over $450 billion remaining in savings. The number that the Fed came up with is much lower than that, and actually much closer to what we're expecting and what we think there is. And as we said, there is still some left. It's going to be weighted differently in terms of who has it less. Because if you look at the commentary of what people are saying, don't have enough money to support myself, don't have enough money for even a $400 unplanned spend. Well, this ties in much closer to what we've been expecting, and it just shows that if we continue this rate, it'll be gone completely. Now, when we look at the aggregate excess savings following the onset of a recession, in 2008, people saved more because people were doing less. In 2020, there was such a huge amount that was stored up because of the 2008 ushered in the beginning of QE, at least in the U.S., where 2020, or the more aggressive QE. I mean, QE was there if you want to look at zero interest rate policies, but then you look at excess savings, we have a lot in there which had time to come out, which is helping to support some of that growth and some of that consumption that we thought was going to continue to slow down, because all of the data we were seeing showed that July was going to be negative. But July retail sales jumped by 0.7% versus the estimate of 0.4%. Then you look at sales ex auto came in at 1% versus 0.4%. The control group came in at 1% versus the estimate of 0.5%. So then it's like, all right, well, what are people spending on? Well, they're spending on Nonstore. They're spending on food services and clothing and groceries. So clothing, sporting goods, that's typically what happens as we head into the beginning of school. So that's not totally surprising, but the non-store food service and grocery is the one that we want to look at the most when we look at how active people are getting. But first, we want to look at, well, what is the real data saying? After adjusting for inflation, U.S. retail sales fell 1.3% over the last year, the ninth consecutive year-on-year decline. That's the longest down streak since 2009. Nominal retail sales increased 2% versus a historical average of 4.7%. So you're getting a little bit of a different picture. It's still better than what it was, but not as strong as it could have been. But also those year-over-year comps are very difficult because you're still have that base effect that you're working against, which obviously is going to continue to fade. And this just puts it into perspective. So the U.S. retail sales, we were expecting in this month-over-month number, we were talking about that deceleration, and we expected it to go negative in July and then not really go further negative in August, but stay at that lower end. Instead, we had that big reversal. U.S. retail sales group, the core group, you can see that moved down. We thought it was going to accelerate to the downside in July. Instead, it accelerated to the upside. So then you start looking at non-store retail sales, which is where you had that big reversal. But the important piece, which is one that we expected just based on the amount of money people are spent, have to essentially redivert or change where it's going, was going to be into grocery stores. And here you can see that big increase in grocery store spending, and which is something that is going to remain elevated, especially when you look at how food prices have moved up again month over month, year on year, which is showing up. And this is, while it's going to be good net for the headline number, this is not good for the way people are spending in terms of discretionary and consumption in general, because they're just going back to buying basics. Food service and drink places, typically they get better in July, which is when you have people go on vacation. So you still have people that are going to go out. They're still going to spend a bit more. And that's when I think that we're going to see some of these different pieces, which are going to continue to be a focal point. But this is one where the grocery store will stay elevated, but this is where we see it falling, especially into August and September. New credit card delinquencies are rising. It just gives you an idea of where the credit cards are and how they're continuing to struggle. We do think that's something that is going to continue to get worse. Then when you look at prices and earnings, the average hourly earnings have turned up even as inflation has come down. So now we're actually net positive. The problem is, though, inflation's starting to turn back up, and some of that is tied to wages, and that's where companies are saying that they expect prices to go up. They're going to raise prices. They can keep prices where they are. And a lot of that is because they're still struggling to hire people. And while the Fed, again, they won't come out and say that they want wages to go down, but they want wages to go down. And this is going to be a problem when you look at where things are, but it's not universal, because when you look at wages around the world, the U.S. has recovered from 2008 where others hadn't. And that's, I think, a bigger issue, which is why the consumer has stayed up much stronger in the U.S. We are a spending society. We don't like savings, versus our Asian brothers and sisters that do have more of a savings mentality. We like to spend. And again, we've been incentivized to do so with some of the discounts, which are really going away longer term when you look at the cost of production. U.S. retail sales, when you look at it on layering it in terms of where they are on a nominal versus real. On a real basis, we're still below where we were in 2021. On a inflation basis, you can see it's going to the new highs. We're on a control group, same situation. But again, we thought things were going to slow down. And as you can see, they still, on a real basis, they're still well above where they were on a pre-COVID, post-COVID basis. U.S. industrial production went up 1% versus the estimate of 0.3. When you look at the factory production, came in at 0.5, positive 0.5% versus negative 0.5% prior. And it's always going to be this waffling act, because we see things kind of just going sideways and being fairly stable at this point with not much movement up or down, just given where we are in bringing some industrial production home, bringing some of these shifts back, which is going to keep things fairly range bound. Now, but tighter credit leads to weaker retail sales, becoming full circle to what we were talking about in the last segment to this segment. You're going to get pressure to the downside. Retail sales are going to slow. People aren't going to get credited the same way. And that's, again, going to cap some of these different pieces when you look at inventories to sales ratios and some of these other important factors. Across all household median deposit balances are at least 30% higher in July 2023 than the average 2019. So the deposit balances are higher, but we're seeing it draw down faster. And that's when this is just another way to kind of look at it. But then when you look at the cumulative change since June 19, vehicles are up 43%, shelters up 20%, fuels up 30%, food's up 25%. So even though you're getting some of this strength, our comment is that things are going to drop faster now because a lot of this excess has been absorbed in terms of savings, and that's going to continue to weigh because on a month-over-month basis, we see inflation reaccelerating, not only just in July, but again in August, which is just going to show more pain on the consumption level. New York Fed survey consumer expectations, household financial situation much worse off versus much better off. Here you can see that people are a bit mixed, where survey major progress shown for percentage of consumers saying that they're in a much worse financial position versus a year ago, but it's not yet a commensurate increase in percentage saying they're much better off. So again, you're looking some of the pieces, but then when you look at consumer expectations, percent saying it is somewhat harder to obtain credit still remains at over 45%. So the credit side is going to continue, as we talked about earlier, is going to weigh on their ability and consumers' ability to go out there, get credit, get borrowing, and try to achieve some of this additional growth. U.S. industrial production, industry groups, manufacturing production has made no progress this year, which is what we were saying for a good chunk of the financial crisis. Expansion activity was stagnant after the first couple of years of improvement, and we don't see much changing, especially when you look at kind of how things balance out on a month-over-month basis. So then when you look at some of the leading indicators, Empire manufacturing came in at negative 19 versus the estimate of negative 1. New orders sank to negative 19.9. Shipments fell to negative 12.3, but prices rose 25.2. So despite the weaker headline and internal data, the outlook for employment got much better. And this looks at the employee side. So when you look at what the Fed is trying to do, which is try to tamp down in employment, trying to tamp down inflation, well, now you're getting, again, this reacceleration to the upside in some of these employment numbers, which is going to be a headwind when you look at, well, how are they going to cut rates with inflation reaccelerating, employment still where it is? And that's why we do think that you get that one more increase. Then when we go a step further and we look at, again, the inflationary projections, inflation is starting to make a comeback per the Empire Manufacturing. Prices paid in the 6-month outlook for prices paid moved higher in August. And again, just looking at the expected, just because we wanted to call out the 37.9, you're getting a reacceleration. So not only have they increased prices already, they expect to continue to increase prices, which again is just showing that acceleration and that increase. So it's not just a July issue, it's more of an August, September, and really through the end of the year, which is where we think this is going to reflect. New orders actually came down, but the expected new orders went up. Now, it's interesting because expected new orders were continuously expected to rise, but they never materialized. And that's something that's really important, where the expectations are improving. And a lot of that is driven based on seasonality, because this is where you normally put in your orders to make sure things are available for the holiday season. And we just don't see that coming to pass. It will get better. We're not saying it doesn't get better. It's just, does it go into a meaningful expansion? And we don't think it does. Philly Fed bounced. It came in at positive 12 versus the estimate of negative 10.2. New orders increased to positive plus 16. Prices paid jumped to 20.8. Employment fell further into contraction, and the 6-month outlook for business conditions fell from a positive 29.1 to a positive 3.9. So kind of a mixed number, but as we were saying, the trend is still down. It's going to have some lumpiness in it. This was obviously a good number when you look at where things are on the manufacturing side. And this Philly's a bit more manufacturing weighted than Empire, so this is going to weigh a bit more when you look at industrial activity. And if you remember when we were talking about national ISM numbers, we had said that manufacturing had hit a floor, and it was going to bounce. We don't believe it bounces into expansion, but it bounces into less contraction. But services was the one where we think that accelerates to the downside, and that meeting in the middle happens, and this is leading into it. But then when you look at some of the leading indicators, it's still cooling, and then obviously prices paid jumping shows that inflation is ramping back up. Consumer sentiment came in at 71.2 versus the estimate of 71.3. Current conditions came in at 77.4, but expectations came down 67.3. So again, you're kind of that mixed side, which is what we were saying, bounce off the bottom and then continue to go sideways. Then you look at growth, the Atlanta growth tracker for wages. After reaching a record high of 13% last October, the pace of wage growth is rolling over sharply, but just, it's important to remember that it's rolling over, but it's still very strong, which is something that they're trying to get in front of. Now, still, obviously, volatility when looking at non-smooth and smooth. The former had a huge drop in April, which was then reversed. Both remain in broader downtrends, but going back to 2010, you're still much higher. And if you're hiring people, which as we've seen, they continue to do because it's hard to find people, this is going to keep things elevated. So then when you look at growth in inflation adjusted average weekly earnings eased in July to 0.2 versus 0.7 in the prior month, still positive, but you're starting to see that reversal. Now, unfortunately, as wages continue to diminish, and not that it's happening quickly, you're getting a reacceleration in inflation, which we think will pull this back negative and create a more pain for the consumer. Components of CPI that are considered staples continue to see a drop in pricing growth, but again, gasoline and groceries are reversing higher. Electricity prices kind of stagnant, utility costs kind of stagnant, but gasoline and groceries is actually pivoting back up. And it's a big part of some of this flexible inflation. And that's where we see some of these bigger issues that are going to continue to kind of eat into the consumer's confidence and how they're going to spend. Now, when we start looking at latest University of Michigan sentiment update, consumers are worrying less about an increase in unemployment next year, which is not exactly what the Fed wants. They want people to not try to change jobs, and you're starting to see the kind of that pivot. And not to say that they want to scare them, but they want to scare them, and they want people to do less with their money. Significant improvement in buying conditions for large household durables. And it's just, again, you can only hold back on so much. And then you do have some additional buildings, as we've seen here. But then you look at the 30-year mortgage rate, which has risen to 7.58%, the highest since going back to 2001. And excluding pandemic, you'd have to go back to 1995 to see something similar. And when you look at the rate of change and that increase, this is where we see a bigger slowdown in this kind of stagnating housing market, because people aren't willing to give up on price, and people are like, well, I can't afford that price given where my income is and what's happening in the market and what these rates are showing. But as of July, there are now more than 1 million multifamily housing units under construction, a new all-time high, and there's still more volume coming. So I know people look at this and say, well, nothing's traded, prices haven't come down. It's like, well, look at how much is still under construction. And unfortunately, you've had the spread where you've had moved to the downside in terms of mortgages, because people can't get mortgages right now. So you're getting more volume. Mortgages are harder to get. And then if you look to the right, there's a hook lower in the spread between the number of homes completed and the number under construction. Homes are still struggling to complete because of labor costs, because of lack of supplies. Even though the supply chain has gotten better, there's still pockets where there's a problem, and that continues to show up in housing. And then realistically, from a builder's perspective, what is your incentive to accelerate it? There's really no reason to accelerate this building. Housing market index pulled back in August to 50 versus the estimate of 56. All components deteriorated, with the prospective buyers traffic falling most. So again, you're starting to get to the end of the buying season, which is August, September, and then people typically slow down. And then when you look in terms of both housing starts and building permits, they've stabilized, but again, they fell swiftly. And then, as we said, they kind of stabilized at this point. July housing starts 3.9% versus the estimate of 1.1. Building permits came in at 0.1 versus the estimate of 1.5. So kind of this balancing act, but there's really no incentive to do much at this point, because who's moving and at what is your price? Even though you have to zoom out, but prices have come down, but not down that much. They're not below where they were. They're still expensive, and it's going to be hard to get people to finance that. Prospective buyer traffic component pulled back in August, drop of a sixth in the gauge, and just gives you an idea of kind of, as we were saying, it was going to bounce off the lows, but we expect it to drift lower, especially as we go into the winter months. Now, when you look at the total worth of U.S. real estate, total worth of U.S. homes hit a record of $46.8 trillion in June, prior all-time high of $46.6 trillion a year ago. Number of homes for sale in the U.S. dropped by 15% year on year. And then when you look at mortgages, again, trying to tie these back, it's like, sure, you can say your home's worth whatever you want, but can you sell it? And based on where the mortgages are going back to 2014, the answer is no. And that's going to be a problem until we get more units coming online to add to the volume to help kind of bring down some of this. In the meantime, and this is why we didn't understand what the Fed was doing with their MBS or mortgage-backed securities, they created this. There was no reason to be buying mortgage-backed securities. Where did you see housing as an issue? So this, again, created additional problems, which has to be unwound. Now, this is, and again, more reason to keep rates elevated longer, as well as actually push them higher once more. So that's what we have for you on the U.S. side. In the next segment, we're going to go deeper into Europe and what is happening on the European inflation front.